I think they've got to the point where they're damned if they do and they're damned if they don't. And that, I think, is going to be the next real problem that we're all going to face. And I think there's a general sense of unease developing, which I think is beginning to be reflected in the gold price. And I don't see the rise in the gold price stopping here necessarily. Well, I don't think that the position is being driven by the COT reports, but we keep an eye on it because really what we want to see is the amount of bullishness that might be already in the particular metal. And I was looking at the situation on gold earlier today because the report was delayed actually until yesterday. And when you look at the managed money category, which basically are the hedge funds, these are algorithmic traders and, all the rest of it, they have actually increased their position very, very sharply, which is hardly surprising because open interest since the beginning of this month has increased by over 100,000 contracts. I mean, that's a very, very big jump. So you would say on that basis that the market has suddenly become really quite overbought. Now, I mean, if we were dealing with a stock in the stock market, we would say that, it's time it had a little bit of consolidation back. We need to get it back into firmer hands before the next move can occur. But in the case of gold and silver, that's very often the right thing to do, but it's now becoming very much an event-driven situation because I find that people are beginning to wake up to this inflation threat. And then there is the next problem. The next problem will be, what are the Fed going to do when tapering begins to undermine financial assets? Bond yields start rising and equity prices start falling. I mean, from the Fed's point of view, that's not an outcome they want to see. So they will probably stop tapering quite smartly or adjust it. I think that's a good phrase, isn't it? They'll adjust their tapering. And if the stock market falls quite heavily, which I think is a very strong possibility, then the only way they can stop it is to bring back quantitative easing. And instead of doing, 125 a month or whatever, they'd probably have to jack it up to over 200 billion a month, to try and stabilize the market. Now, that then destroys the dollar. But then you've got foreigners holding dollars already. And about 14 trillion, I think, at the last count of that, was invested in equities. Equities start tanking. If the Fed doesn't do anything about it, the foreigners are going to sell anyway. So, I think they've got to the point where they're damned if they do and they're damned if they don't. And that, I think, is going to be the next real problem that we're all going to face. And I think there's a general sense of unease developing, which I think is beginning to be reflected in the gold price. And I don't see the rise in the gold price stopping here necessarily. I think it's too early to say that people are viewing it as not so much the gold price rising, but the purchasing power of the dollar falling. But it's not going to take an awful lot for people to begin to think that way.
Mm-hmm. So you recently wrote an article as well about the golden cross in the 10-year Treasury yield. Could this be contributing to gold's momentum as well?
I think for technical traders, probably yes. The reason for pointing that out is that a golden cross is a very reliable indicator of a change in underlying trend. And in this case, the trend is of the yield on this 10-year US Treasury bond. What that is telling us is that the yield is going to go quite a lot higher. But if you marry that with what we've seen in terms of monetary inflation, I mean, it really should be no surprise. So the people who would pay attention to a golden cross aren't necessarily following the underlying developments, which are far more serious than a technical development that might support a rise in the yield to around about 3%, which is roughly what it's telling us at the moment. It's a lot more serious than that. And we're going to see yields on US debt far higher than that, I think, particularly at the short end. There may be some leveling out as you go longer and longer, because what tends to happen is that there is always an appetite amongst the pension funds and the insurance companies for long-term, high-yielding, nominal yielding government debt. So there will be some support at the long end. But what I do see is that interest rates at the short end, they will rise against the desire of the Fed. The Fed will have no option but to follow it. It won't be led by the Fed at all.
So you and I have spoken before about the Basel III regulations, some of which are going to be coming into effect first thing in the new year. So what kind of market reaction could we see as a part of that looming deadline? Or has the market already priced that in?
Well, I think first thing to say is that the point about the Basel III net stable funding ratio regulations, which is what you're referring to, is that it doesn't necessarily force a bullion bank to run a balanced book or to remove itself from derivatives dealing entirely. It places some fairly strict conditions on how they will operate unless they're prepared to accept a balance sheet penalty. By balance sheet penalty, what I mean is the cost of funding it out of your liabilities is increased compared with, say, holding other assets. And the idea behind this was really following the great financial crisis, the failure of Lehman. The G20 got together and instructed the Bank of International Settlements with its Basel Committee to come up with new regulations so that it would never happen again. And one of the big issues, obviously, was derivatives. Now, the forward market in London, the LBMA seemed keen to insist that it's not derivatives because something like 60% of trades settled, physically. They're not actually settled physically, but they cross out. But anyway, and of course, you've also got regulated derivatives like futures. It's going to be more expensive for people to run positions in those in gold and silver derivatives and derivatives and other commodities, incidentally. So it doesn't necessarily stop it. America has already introduced the requirement to comply with these regulations, the net stable funding ratio. Europe has also done the same. The UK is going to do this from the first day of trading next year. So we're the laggards in this. I mean, I talk to other people like in Australia and they've already done it out there and so on and so forth. It's a slightly messy scene because a European regulator will look at, say, for example, UBS, because the Swiss are in with the European regulator on this one, and see what their position is in London. So even though London hasn't gone with it yet, as far as the European regulator is concerned, they're already applying these new rules to banks like UBS or Deutsche Bank or whoever. So it is a slightly complex situation. It is not black and white, quite in the sense that everybody's got to just give up running books, if you like, unbalanced books in the market. But what we can expect is that over time, the liquidity in that market will diminish from banking sources. There is a far bigger problem, and that is it's hyperinflation, as we were talking earlier. Sooner or later, and it's probably sooner rather than later, bullion banks with short positions, and that community is always net short, incidentally, are going to be running scared and wanting to close down those short positions simply because with all the big central banks printing money and trying to suppress interest rates, the gold price and the silver price are going to run away from them. And they don't want to be caught out like that. So there's a lot of tension in the market at the moment. And I think that it's only a matter of time, short period of time, before prices do go significantly higher because of the fundamental background, the loss of purchasing power for fiat currencies. And those banks are going to want to close down their positions as much as possible. I think the real problem they have is probably on COMEX, because they need to dispose of a futures position in order to square their books. Whereas in London on the LBMA, their short position is basically to customers, if you like, depositors with gold-linked accounts. And I think they just turn around and say, we're removing the gold link in your deposit account. We perfectly understand if you want to take your deposit elsewhere. So in that sense, London is quite easy to deal with. A lot of people would be terribly upset. But we have seen the Dutch banks in the past have done this. ABN AMRO and I think Rabobank have done this in the past. I think in 2011, they no longer were prepared to deliver gold on a customer's request against an unallocated account. So that's a milder version of what we're talking about. But I think the real problem is going to be on COMEX in this one.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.